Namaskara. Welcome to the session on cash flow statement. And in this particular statement, you are going to understand what exactly the cash flow statement and how exactly the cash flow statement is to be prepared as per accounting standard 3. What are the different steps to be followed? What are the different ledger accounts are to be prepared? And finally, how to prepare cash flow statement. To understand the cash flow statement, basically you need to understand what exactly the cash flow. When we say a cash flow, in the sense, cash flow consists of three activities. The three activities such as operating activities, investing activities, and financing activities. So these three activities comprises the cash flows. The first one is operating activities, mainly consists of the operating activities of the business, the day-to-day affairs of the business with respect to receipt of income and payment of expenses. And this operations mainly deals with the transactions which occurs in the day-to-day affairs that fetches either the income or loss. In addition to that, the non-cash items or non-operating expenses and incomes that will be incurred or received during the course of a particular year. When it comes to a cash flow from operating activities, there are three things that to be considered, that is net income, non-cash items, and changes in working capital. The operating activities consist of the generating revenue. This revenue can be generated by paying certain kind of an expenses and flow of funds. These non-cash items may be pertaining to maybe a dividend paid or maybe a tax paid, etc. And the changes of working capital pertaining to the current assets and current liabilities. So combination of three items here. So net income, that is profit for the year, and we need to adjust certain kind of non-cash items like maybe expenses or maybe the incomes, and you need to adjust with the working capital items such as that is to say the current assets and current liabilities. That is pertaining to the first activity, that is called cash flow from operating activity. These cash flow from operating activities may be classified into two things, that is inflow of operating activities and outflow of operating activities. All inflows are to be measured as plus value and all outflows are to be measured as negative value. So inflows are to be added and outflows are to be deducted. Inflows such as any kind of an incomes that have been received and expenses which are to be paid back. So based on these inflows and outflows, we will come to know what exactly the net flow with respect to operating activities. For that, a certain procedure is to be, a particular procedure has to be followed with respect to current assets and current liabilities. The rule for current assets and current liabilities while preparing the cash flow from operating activities is increase in current asset increases cash, decreases cash, that is to say a outflow of cash which is to be deducted. Decrease in current asset is an increases cash, that is to be added, that is to say inflow of cash. And as far as the liabilities are concerned, current liabilities are concerned, decrease in current liability decreases cash, increase in current liability increases cash. Wherever there is an increase with respect to the current liabilities are concerned, decrease means minus and increase means plus. And when it comes to the current assets, increase in current assets are to be minus and decrease in current assets has to be plus. So these are the four rules are to be followed with respect to the working capital items. So there is a separate procedure, maybe a format in which you need to understand. First, you need to take the net profit for the year, as and when two balance sheets of an organization is given, current year minus previous year. So that will be the net profit. So the current year, for example, the 5 lakh rupees, and the last previous year it may be a 4 lakh rupees. The net increase that comes to around 1 lakh rupees. So for this net profit, you need to do the adjustments pertaining to non-operating items. It's a non-fund or non-cash items such as maybe expenses or maybe incomes. So all expenses are to be added. All non-cash items expenses are to be added. In simple, items appears on the debit side of the profit and loss account. And all non-cash and non-operating incomes are to be deducted, that is to say, items appeared on the credit side of the profit and loss account. This is the first step to be followed in case of a cash flow from operating activities. The second step is called, with respect to the working capital, current assets and current liability. The current assets and current liabilities, the rules is that increase in current liability, decrease in current asset is to be added, and vice versa is to be deducted. Decrease in current liability, increase in current asset. So first step with respect to expenses and incomes, second step pertaining to the current assets and current liabilities, finally income tax paid is to be deducted. That fetches the cash flow from operating activities. This is the first step, the major activity in which, in case of a cash flow statement, one needs to understand. The second activity is called cash flow from investing activities. This cash flow from investing activity is mainly pertaining to the purchase and sale of long-term assets. The long-term assets are maybe non-current assets pertaining to the fixed assets and investments. Either it may be a purchase or it may be sale. So how much of money has been used or generated from making the investments during a specific period of time, that fetches the net cash flow from investing activities. In case of a sale of an asset, it is a source of income, cash inflows. In case of a purchase of an asset, that is called cash outflow, where payment has been made. So on that basis, we will come to know what exactly the net cash flow from investing activities. The third activity is called the cash flow from financing activities. This financing activity is mainly about the funding of the company. Based upon the net amount that has been generated in a given period of time to finance its business, mainly pertaining to its equity or its any kind of a debt, either it may be the issue or it may be repurchase. When it comes to the shares, either it may be a reissue of shares, or it may be a redemption. Or in case of a debt has been raised or debt has been paid back. And finally, the payment of dividends. So this consists of three items pertaining to the share capital and any kind of non-current liabilities such as bank loans and debentures and so on, and finally the dividend paid. So combination of these three items put together, that gives the cash flow from financing activities. So there are three activities as we have discussed. The one is operating activities, second one is investing, and the third one is financing activities. So all three activities put together, you will get some value, maybe a positive or negative value. For that value, if you add the opening balance of cash and bank, then you are going to get the closing balance of cash and bank. So this is how you need to prepare a statement. First, you need to prepare a statement pertaining to the operating activities plus investing activities plus financing activities. The grand total is to be added to the opening balance of the cash and bank. Then that gives the closing balance. Then the same closing balance that was appeared in the balance sheet. So the closing balance, what you are going to arrive in the cash flow statement, it has to tally with the closing balance that was given in the balance sheet. This is what exactly the procedure to be followed in case of a cash flow statement. Let us solve one problem. Practically, you will be able to understand how to prepare a cash flow statement. Basically, there are two steps are there. There is you need to prepare relevant or necessary ledger accounts as far as any adjustments are given, and finally only one statement, that is called cash flow statement as per accounting standard 3 in indirect method. Let us understand this kind of a question. It was given in a question paper. The two balance sheets of Mukund company is given for the year 2014 and 15, and liabilities and assets are clearly mentioned. Under the liabilities, you have share capital, preference share capital, general reserve, profit and loss account, creditors, bills payable and provision for taxation. And for the asset side, you have goodwill, land and buildings, plant, stock, debtors, bills receivable and cash. There are three adjustments are there. The one is the dividend paid to the tune of 40,000 rupees, and depreciation written off during the year is 40,000 rupees as far as the land and buildings, and 20,000 rupees for plant. Finally, there is a provision for tax made during the year was 90,000 rupees. Once the balance sheet is given, one needs to identify the components of the liabilities and assets as far as the grouping is concerned. What are the liabilities comes under shareholder funds, non-current liabilities, current liabilities. And what are the assets comes under non-current assets, current assets. This grouping is needed in order to follow the further procedure. Because while calculating the cash flow from operating activities, we do consider only the current assets and current liabilities. So one needs to understand what are the current assets and current liabilities that are given in the question. So let us understand. In the assets and liabilities position, first identify what are the current assets and what are the current liabilities. In case of a balance sheet of liabilities and assets, the current assets are stock, debtors, bills receivable and cash. These are the four current assets are available in case of this balance sheet. Stock, so cash being the value given as 50,000, 36,000 rupees. This opening balance of cash will be added back to all activities at the end. After determining the value of operating activities, financing activities and investing activities, we are going to add back this 50,000 rupees, opening balance of 50,000 rupees, so that you should get an answer of 36,000. So your cash flow statement answer should be the closing balance of cash, that is called 36,000 rupees. So while preparation of cash flow from operating activities, we take current assets except cash and bank balance. So as of now, we have three current assets: stock, debtors and bills receivable, and in case of liabilities, we have creditors and bills payable. So totally 3 plus 2, 5 items, 3 current assets and 2 current liabilities. This is just an identification. Next is, you need to see, if you have any kind of special items such as goodwill, preliminary expenses, or any other kind of an asset in which you may treat it as a depreciation, general reserve, any kind of fund is being transferred to general reserve from profit and loss account. So these are all the special items in which one needs to identify. So in this particular balance sheet, you have goodwill. Goodwill amount is reduced by 50,000 rupees. This is called goodwill written off, and general reserve of 60,000 rupees, that is 80 to 1,40,000. 60,000 rupees is being transferred to general reserve. So these are the two items. These two items appears in the profit and loss account. So profit and loss account items comes under the operating activities. So while preparing the operating activities, we need to remember these two items. Next is, come back to the adjustments. So the dividend paid is given 40,000 rupees. The dividend paid, it is a direct item. It is to be treated directly, and any kind of an adjustment has to appear in two places. Is what the dividend paid is a 40,000 rupees, where we need to add back to the profit, net profit, while determining the cash flow from operating activities. 40,000 rupees, it is to be added back, non-cash item. And another place is 40,000 rupees is the dividend paid. It is a payment of dividend. It is an outflow of cash, and again it will come in the financing activity, the last activity. And depreciation written off during the year 31st March 2015 on land and buildings 40,000, plant 20,000. So you need to prepare land and buildings accounts separately, plant account separately, transfer this depreciation to the respective ledger accounts, then close the account, find out the balancing figure. That balancing figure may be a purchase or a sale. And the third adjustment is called provision for taxation. And taxation, it was given as 90,000 rupees. We need to prepare a separate provision for taxation account and transfer this provision. Provision is to be transferred to profit and loss account, and the balancing figure you may get as tax paid. So that's how, wherever there is a necessity, we need to prepare a separate ledger account. That is the first step. So for dividend paid, need not to prepare, directly it is to be adjusted. And as far as the second and third adjustment, we need to prepare ledger accounts. To start with, first and foremost, the land and buildings account. To start the land and buildings account, it is an asset account. First transfer the balances, the opening and closing balances. Asset account opening balances starts from the debit side. So, what exactly the opening balance of land and building? In the balance sheet, it is given as land and buildings opening value 4 lakhs, closing value 3,40,000 rupees. So, two balance brought down, that is called opening balance 4 lakhs, and the closing balance of two balance carried down, the buy balance carried down, it's called 3,40,000. So, first step is called transfer of balances. Next is called the adjustment, says that there is a depreciation to the tune of 40,000 rupees. So, that 40,000 rupees depreciation, that is taken on the credit side by P&L account, that is called depreciation. So, that is the only one adjustment pertaining to the land and buildings, no more further sale or purchase. So, close the account. While closing the account, debit side is higher, debit side is 4 lakhs, credit side is 3,80,000, therefore, the balance of 20,000 rupees will be treated as the sale. Sale, again, it is a cash outflow. Cash outflow of land and buildings. Land and building is an investing activity. It will come under second activity, investing activity. That is the first adjustment with respect to land and building. Similarly, you need to prepare plant and machinery account. Plant and machinery account. Similarly, take the balances. The plant value, opening value is 1,60,000 and closing value is 4 lakh rupees. So, two balance brought down 1,60,000, buy balance carried down 4 lakh rupees. As the adjustment says that there is a depreciation to the tune of 20,000 rupees, and that depreciation is to be taken on the credit side by P&L account, that is called depreciation. So, no more further adjustments pertaining to plant and machinery, close the account. Here the credit side is higher, 4 lakh plus 20, 4 lakh 20,000, and debit side is only 1,60,000, therefore, the balancing figure is 2,60,000, that is treated as the purchase of plant and machinery. Balancing figure appeared on the credit side is called a sale as far as the asset is concerned, and balancing figure on the debit side as far as the fixed asset is concerned, it is called purchase. So, the balancing figure is 2,60,000, that is called purchase of plant and machinery. It is a cash outflow. Purchase is an outflow, it is called minus 2,60,000 rupees in case of a cash flow from investing activities. Third adjustment is pertaining to the provision for taxation. Provision for taxation is a liability, non-current liability. First take the balances. In the balance sheet, it is given that opening value is 80,000, closing balance is 1 lakh. So, buy balance brought down 80,000, two balance carried down 1 lakh. So, after transferring the balances, the adjustment says that there is a provision for taxation made during the year. It is not paid, made during the year. So, provision is taken on the credit side of the account, that is to say 90,000 rupees. This provision is transferred to profit and loss account. So, by P&L account, that is called provision for the year 2015, around 90,000 rupees. So, that is the adjustment. Close the account, credit side is higher, that is 1,70,000, and balancing figure is 70,000 rupees. That is called as tax paid. So, if provision is given, normally you will get a balancing figure as tax paid. If tax paid is given as an adjustment, normally the balancing figure would be provision. So, these are the only three adjustments where you need to prepare the ledger accounts, and we have prepared the land and buildings account, plant and machinery account, and provision for taxation account. The first adjustment is called dividend paid. The dividend paid, we need not to prepare any kind of a ledger account, and that is to be treated directly. Now come to the second step, that is called cash flow statement as per accounting standard 3. This cash flow statement consists of three activities: cash flow from operating activities, that is A; cash flow from investing activities called B; and cash flow from financing activities, that is the last one, C. First, we deal with only the operating activities. The very first step is called, you need to take the net profit for the year. The problem starts with net profit for the year. In the balance sheet, under the liability side, the profit and loss account is given that opening balance is 60,000, closing balance is 96,000. So compared to the previous year, the profit position is increased to the tune of 36,000. That's what exactly the net profit for the year. Actually, the meaning of net profit for the year while taking the operating activities is called net profit before dividend paid and before taxation. So this is what exactly what normally this net profit is to be taken before any extraordinary items or non-operating items. For this kind of net profit, we need to add all non-cash or non-operating expenses, including working capital items. So, what are all the kind of non-cash or non-operating expenses that is given in the question that is pertaining to this particular question? The first one is called the dividend paid. The adjustment also it is given that there is a dividend paid is 40,000 rupees. All expenses are to be added, all incomes to be deducted. So, the first and foremost is dividend paid. Second is there are two ledger accounts you have prepared pertaining to the land and building and plant and machinery, that is depreciation. So, depreciation on land and building is 40,000 rupees, it is clearly given in the adjustment, and one more depreciation on plant and machinery, that is called 20,000 rupees. So, both are expenses that are taken in the that are added back to this net profit for the year. And next is we have prepared the provision for taxation. The taxation made during the year that is given in the question as the adjustment, that is called 90,000, that is also taken. Next come to any kind of a special items and working capital items. There are two things that is called general reserve and goodwill written off. Already we have identified the special items, it's called general reserve and goodwill. The transfer to general reserve, it is increased position, opening value is 80,000, closing value is 1,40,000. Therefore, 60,000 rupees is transferred to general reserve. And goodwill written off, where the opening value is 2,30,000 and closing is 1,80,000. Therefore, it is reduced by 50,000. That is to be treated as goodwill written off to be added back to the profits. Then, if we have any kind of an assets, current assets and current liabilities that are to be taken into consideration. With respect to the current liability, that is to say creditors, creditors value is increased. Opening value is 1,10,000, closing value is 1,66,000. Increase in current liability increases cash, that is to say 56,000. It is added. So, any kind of increase in creditors, add. Decrease in current liability, minus. Increase in current asset, minus. Decrease in current asset, add. So, this is what exactly it is to be taken into consideration. Next is find the total. The total comes to 3,56,000 with respect to the the add items. Now 3,56,000 plus the net profit is 36,000, that comes to 3,92,000. So for this 3,92,000 we need to deduct any kind of a non-cash incomes are there or any kind of a current assets and current liabilities position. So there are three items are there. One is the bills payable. As the current liability position is decreased from 40 to 32, 8,000 rupees is decreased, decrease is to be taken as minus, and the stock position is increased, that is to say stock from 1,54,000 to 2,18,000. Stock, debtors, bills receivable, all the three current assets position have been increased. So any kind of an increase in current asset, it is to be deducted. So 154 to 218, 320 to 4 lakhs, 40,000 to 60,000. So all the three current assets were increased. So what is the total deductible items? That comes to 1,72,000. Now deduct this 1,72,000 from 3,92,000. So 3,92,000 minus 2,20,000, that comes to 3,92,000 minus 1,72,000, that comes to 2,20,000. And finally deduct the income tax, and income tax paid is given as 70,000 rupees. This 70,000 rupees is to be deducted, then you will get income tax is to be deducted as 70,000, then you will get 1,50,000. 2,20,000 minus income tax paid to the tune of 70,000, so that the net cash flow from operating activities only, that is A, the part A, that's called 1,50,000, that's called plus. This is the first part. And the second part is called cash flow from, this is called the summary of the entire activity, cash flow from operating activities. Second activity is called cash flow from investing activity. Cash flow from investing activities mainly pertaining to the sale and purchase of fixed assets. It's land and building, plant and machinery. Both the accounts are prepared. In one land and building there is a sale, in case of a plant and machinery there is a purchase. So in case of a land and building, where there is a sale of land to the tune of 20,000 rupees, in case of a plant and machinery, there is a purchase of plant and machinery to the tune of 2,60,000. So all outflows are to be treated as minus, the sale inflows are to be treated as plus. So plus 20 minus 260, that comes to minus 240. This is called cash flow from investing activities. Operating activity 1,50,000, investing activity minus 2,40,000. Let us see what is the cash flow from financing activity. Financing activity mainly deals with the share capital, debentures, any kind of a bank loan is there, and dividend paid. So as far as the share capital is concerned, there is an issue is that share capital position has been increased by 2,16,000, and in case of a preference shares, it was reduced by 1 lakh, that is called redemption of preference shares to the tune of 1 lakh rupees, and finally dividend paid, that is to the tune of 40,000 rupees. So the net cash flow from financing activities alone, that is C, is called minus 76. That's called cash outflow minus 76. There are three activities: inflow, operating activities, investing activities, and financing activities. A is 1,50,000, B is minus 2,40,000, and C is 76,000, minus 76,000. So A plus B plus C is called cash flow from all activities. The net cash flow from all activities put together is called minus 14,000. That's called negative value. That's called an outflow of 14,000 rupees. If you add back the opening balance of the cash at the beginning, as the opening balance in the balance sheet is given as 50,000 rupees, if you add that 50,000 rupees, and you will get the balancing figure as closing balance, that is called 36,000. See, in the balance sheet it is given that the closing balance is 36,000. Now your answer is 36,000. Therefore, the solution is correct. This is how you need to prepare this cash flow statement, and if you have any kind of a doubts, feel free to contact me on my mail ID. And thanks for watching. Keep learning. Stay safe. Thank you.